The United States student loan market has reached a staggering $1.7 trillion, operating almost entirely without the underwriting standards of traditional credit. Because these are federally guaranteed, any student at an accredited school can accumulate tens of thousands of dollars in debt before they have established an income or a credit history. Carrying this much liability so early in life raises a practical macroeconomic question. How does this initial debt load alter a consumer's trajectory in other credit markets later on? There is a common assumption among professionals known as debt aversion. The theory suggests that heavily indebted graduates feel the weight of their loans and will actively avoid taking on further debt. A 2021 study from researchers at the Federal Reserve Board used a proprietary dataset of merged credit and educational records to test that assumption. The data shows that the debt aversion theory is incorrect. Higher student loan balances actually increase a borrower's demand for additional consumer credit. However, there is a countervailing force. Because this debt damages a borrower's risk profile, it simultaneously triggers a contraction in the available supply of credit. The net result for the consumer, whether they borrow more or less, is determined by the underwriting standards of the specific secondary market they are entering. Graduates with heavy debt loads do not voluntarily shun the credit market. Their demand for borrowing spikes, but their access is systematically fractured by lenders. To understand why demand rises, we use a standard life cycle model of consumption. Households naturally want to borrow early in their lives to smooth out their standard of living against the higher incomes they expect to earn later. In this specific model, we define student loans as a unique obligation. They are fixed payment, non-dischargeable, and exceedingly difficult to refinance. During repayment, these loans act as a persistent reduction in disposable income during early working years. The optimal response is to increase early life borrowing to fill that income gap, maintaining their level of consumption. In a market without frictions, carrying student debt would unambiguously drive up consumer borrowing, but real-world markets have frictions, specifically borrowing limits imposed by lenders. Because student debt increases delinquency probability, the borrower's credit limit becomes a decreasing function of their loan balance. This creates a structural tension. Unconstrained borrowers increase their borrowing due to demand, while constrained borrowers are forced to reduce theirs because of supply. Determining which effect dominates requires an analysis of how different lenders assess risk. Unsecured credit cards carry significant delinquency risks relative to credit scores. Collateralized products, led auto loans, have lower risks because the lender can repossess the asset. As a result, credit cards and mortgages are tightly rationed, while the markets for auto and installment loans remain relatively loose. Macroeconomic theory predicts a clear divergence. The exact same student debt shock will cause borrowing to spike in loose markets and plummet in tight ones. Proving this divergence in the real world requires isolating the causal impact of the debt. This is an econometric challenge because of endogeneity and omitted variable bias. Raw estimates are often corrupted by unobserved variables like family wealth or baseline ability, which influence both the decision to take out a student loan and future credit behavior. The researchers bypass this by using an instrumental variable strategy. They use the exogenous changes in in-state public university tuition during a student's prime college-going years as their primary instrument. Tuition shocks allow them to isolate the debt forced upon the student by rising costs, filtering out their unobserved financial background. This chart shows the baseline OLS estimates. Without correcting for endogeneity, the data shows a universally positive correlation between student debt and credit use across all categories. However, the two-stage least squares causal data reveals a different story. In panels A, B, and C, we see loosely underwritten markets: auto, goods secured, and installment loans. A $1,000 increase in student debt causally increases the probability of a borrower taking out these loans. This empirical spike confirms the demand channel. Borrowers are actively trying to smooth their consumption. But in the tightly underwritten credit card market shown in panel D, the results are inverted. Here, the probability of holding a credit card drops by as much as 2.4 percentage points. By controlling for endogeneity, the data proves the theory. Borrowers want additional credit to offset reduced income, but are systematically locked out of tight markets. Could this severe drop in credit card holdings simply be a case of borrowers voluntarily choosing not to use them? To test this, we have to look past the extensive margin, whether someone has a card, and examine the intensive margin of credit limits versus utilization. First, we look at total credit card limits, reflecting the supply of credit. Panel A shows a $1,000 increase in student debt causes total limits to fall by more than $1,000 during a borrower's late 20s. At the same time, Panel B shows that the utilization rate, the percentage of available credit being used, is rising by 1 to 3 percentage points. Overall capacity is shrinking, but the percentage of that capacity being used is increasing. This dynamic proves borrowers still demand the credit. The lenders are the ones cutting them off. The drop in credit card holdings is an involuntary constraint. Student loan borrowers are being financially squeezed rather than practicing behavioral restraint. Student debt acts as a wedge in the consumer credit ecosystem. It forces a consumption smoothing response that drives borrowers to seek out more debt, yet it simultaneously makes them too risky for tightly underwritten markets, fracturing their financial profile. This has severe welfare implications for individual households. Losing access to unsecured credit removes a vital shock absorber, severely restricting consumption for households with low liquidity. But the implications for the broader economy are also significant. While federal student loans are government guaranteed, the risks associated with them do not stay isolated on federal books. Spillover demand is pushed into private, loosely underwritten markets, where losses are not guaranteed by the government. Student debt distorts the entire consumer credit architecture, pushing risk out of government ledgers and into the inherent vulnerabilities of the private sector.